So, hello and good afternoon. I welcome everyone to today's Trading Spotlight webinar here together with Admiral Markets on Friday. It's the 13th of December 2019. And my name is Klatt. I'll be the moderator here for the upcoming 45 minutes, something like that. Today we want to have a look at a topic which at first glance is very, very basic. At second glance, probably I prepared something which gives you kind of an, let's call it, in Germany we call it aha moment. This is like you, there's a light bulb which probably pops up then, even though it's a very basic topic and it should be clear. Still, probably some of you haven't looked at it that way, so that's it in regards to the introduction. Let's have a look here at today's agenda and what to expect in the upcoming minutes in regards to the beginner's guide to Forex terminology. So we want to introduce, respectively, talk about major currency pairs. We want to have a look at cross rates, exchange rates. In general, we want to have a look at the bid and ask price. Bid and ask, you probably have seen it. It's the sell and the buy. You can see within your Admiral trading platform the result. The difference between those two is the spread. We want to have a look at the pip and also what we can understand under margin, respectively, what we talk about when it comes to leverage. And probably also here, some of you probably recall one webinar we had here within the series. We discussed how this leverage, especially the so-called effective leverage, what we will introduce today is in fact the leverage which is provided to you by the broker, but the leverage in general has potentially an impact on your overall profitability in your trading. In fact, before we start, sure, we could now start about to talk about me. I already mentioned it at least between the lines. So I'm located in Germany, in Berlin, Germany, and still I recommend you to probably read the interview I gave to Admiral something like 6 months ago, 5 months, 4 months ago, I'm not sure. But when we started the series, the idea was to introduce every speaker, Marcus and Paul and myself here, to the audience, who we are, where we come from. And within this interview, I think many aspects probably become clear. You can also, by the way, I just saw it here, you can find all details around me here in the chat box. But I'd like to talk about the broker who makes this event here possible. And about Admiral Markets here in general. So one thing which is already clear, if you're not here for the first time, you already know that. Most of you probably have checked the website. You must have registered somewhere, so you were probably on the website admiralmarkets.com, and you had an overall idea, or you got an overall idea already what makes Admiral special. So it's not only that they offer 20, it's 20 and more offices around the globe, but it's over 8,000 financial instruments which are offered by Admiral, and that they are fully regulated, licensed by the FCA, by the ASIC in Australia, by the SISIC, for example. And what also probably came to your mind, it pops up directly when you come to the website. It's the typical spread here when it comes to the DAX 30. And what I can say, based in Germany, I can say that Admiral is here considered to be the so-called DAX expert. So what we talk about when traders get together, last month, for example, we had the World of Trading in Frankfurt at the biggest trade fair, in fact, in Germany. Every year, and Admiral was there with a presence too, one of the biggest presences, one of the most impressive presences, based on also the presentations which were given there. And you could clearly, if you compared Admiral to other brokers, you could clearly see that there's a highly competitive offering with 0.8 points cost per CFD, which is already highly competitive. Some of you probably have checked the so-called Admiral Prime offering. Admiral Prime is giving you a 0.2 point spread in the DAX, and you pay a commission on top of that, which is probably very interesting for very short-term traders. And why do I mention that right now? It's not only because of the DAX, but also in regards to FX. There's some external websites, so third-party providers who give you a so-called spread. How can we call this? It's a spread tool. Yeah, you can compare spreads from brokers here, from live data, which are worked out here, respectively, where brokers' spreads and, for example, EURUSD are compared to each other. And what you will find out when looking at Admiral Prime is that it's not just only a very competitive FX offering, but if I'm not mistaken, so at least the last data I collected there, respectively, I compared with other brokers, it was the tightest spread in EURUSD you could find when comparing to other brokers, without naming now any broker of these. But it's also true that in the FX environment, Admiral has a very, very, very competitive offering. So definitely worth a look. Feel free to check out these external third-party providers also to get a better overview, compare brokers with each other. You will see that Admiral is usually at top of that. And yeah, so in addition to that, Admiral is offering the so-called trading spotlight series here, together with Marcus and Paul every Monday, Wednesday, and today on Friday. And in this regard, now let's come to today's topic, the beginner's guide of Forex terminology here. And let's start with major currency pairs. That's, again, a little unfortunate. Something went wrong, I think. But for whatever reason, now you can see all the bullet points already, but still, we go through this step by step here. Usually I want to have it appear after and after, but whatever. So major currency pairs, how can you understand this? If you listen to someone talking about the markets, if you read an article, and there is someone who refers in regards to FX to majors or major currency pairs, what's meant by that? So in fact, what we usually mean then is, well, what we refer to the most traded currency pairs in the world, which are all called majors. And these currencies usually involve currencies like the euro, Japanese yen, pound sterling, Australian dollar, Canadian dollar, and the Swiss franc, which are traded against the US dollar. So you could also consider, for example, currency pairs like Euro GBP or Euro JPY, a major currency pair due to the high volume which is traded there. But I usually refer to these as, in this specific case, Euro GBP, Euro JPY, as so-called cross pairs. Something we will introduce in a later slide here. When I talk about majors, I usually do it, and most of traders, FX traders around the globe, also refer to majors when talking about US dollar. And here, the US dollar traded then against these currencies. So we are not talking about the US dollar, for example, being traded against the Russian ruble or the Argentinian peso or something like that. But we refer to usually the US dollar being traded against Euro, JPY, GBP, and so on. And the interesting thing now is that in regards to these major currency pairs, so we define majors as currencies being traded against the US dollar, and here it's 6. Yes, it's 6. Some of you probably may say, okay, we can also take the New Zealand dollar into that summary here, and this is something I did here. So when looking at EURUSD, for example, we refer to EURUSD as the so-called euro. So if FX traders talk, they don't say EURUSD. Some of them do, but most of them say something like euro or something. Dollar JPY is only dollar yen. GBP USD is cable. Very interesting right now, especially after the general election in the UK. So everyone is somehow talking about pound sterling, respectively, cable right now, GBP against the US dollar. But what's probably more interesting is, why do we talk about cable here in this case? So, I mean, I get dollar yen, okay, I get US dollar against Swiss franc. It's a Swissy. Loonie is kind of difficult already, while Aussie against the Australian dollar, but also here the Kiwi, an animal which is located, which lives in New Zealand, we get this somehow. But when referring here to GBP USD and to cable, some of you might just wonder what's this? In fact, the explanation for that is quite easy. it was the first a cable which was or which connected Great Britain with the the east coast of the U.S., so New York. So there was a cable through the Atlantic, if you want, and that way those two countries, those two not just countries, but continents in this case, were connected with each other, and there was a way to communicate with each other. And that's why we refer to pound sterling, the currency in the United Kingdom, and the US dollar, currency in this case, New York, for example, refer to this currency pair as a cable. So a reference to this cable, which was there at the beginning of at the end of the 19th and at the beginning of the 20th century. So this is how you can understand a cable then. I have to admit, I have some difficulty, but there's probably a very easy explanation to that. Some of you probably can look it up right now and probably find something when looking for loony and definition. Probably there's an explanation already connected to that. So feel free to post this here in the chat box, respectively. If you watch this video on YouTube, the recording, then feel free to post it in the chat box then below. Highly appreciate it, and probably the starting point of a nice discussion, respectively, exchange of other Forex terminologies which are of interest, respectively, which people might want to get or dig a little deeper into. So cross pairs. I've already introduced this with my thoughts over the last minutes here in regards to the major currency pairs. So usually cross rate refers to currency quotes which do not involve the US dollar. Everything involving the US dollar usually refer to major, respectively, not everything, but you see when looking at Euro, JPY, GBP, and everything. So once we do not have the US dollar included here, regardless of which country the quote is provided in, then we're talking about so-called cross rates. So Euro USD is a major currency pair, but when looking, for example, at Euro JPY or at Euro GBP or Euro Swiss franc, then we talk about Euro crosses, respectively. Also here, GBP, JPY. The thing is now, you might probably say, why don't we talk about Euro GBP, about a pound cross, but here we talk about the pound cross. And that has to do with the fact that you can see that we are referring to the first currency which is mentioned here. So this is the cross rate we are looking at then here. So Euro Swiss franc is a Euro cross, respectively. Euro GBP is a Euro cross. In GBP JPY, well, we then look obviously at a pound cross, respectively. Aussie Swiss franc, for example, then is an Aussie cross, respectively. NZD against JPY is a Kiwi cross. We can refer to that like that. Interesting enough, I have to say, and we will see this when looking at the pips and a little later. It's not very common, let's say, that we refer to JPY crosses, or yen crosses, in fact. So usually you talk about, again, you usually talk about the cross, on the Euro cross or pound cross or sterling cross in regards to the first currency, which is mentioned here. So since the JPY is usually the second currency you look at here within this is then one of the main reasons why we're not referring to JPY crosses then in this regard. So yeah, this is it in fact in regards to cross pairs. So now we introduce major currency pairs, every currency which involves the US dollar, why cross pairs are currency pairs, currency quotes which do not involve the US dollar. That's in fact it when it comes to majors, respectively to cross pairs. So now let's have a look here at the exchange rate. Obviously, that should be quite easy to understand. Exchange rate means the expression of the value of one currency expressed in terms of another. For example, if Euro USD is 10.72 here, 1 euro is worth 1.1072 US dollar. So for every euro, you get 1.1072 USD. In fact, so by the way, here the mini terminal. This is something you can find in the so-called Supreme add-on yeah, Admiral Market Supreme Edition you can download on the website for free if you're using the MT4, respectively the MT5. So that means nothing more than, in this case, when looking at Euro USD, an exchange rate obviously gives you an idea of where or against how much euro you can sell against the US dollar for which price, respectively. Here, which how many euros or how many US dollar you can buy for €1 in this case. So this is how you can understand exchange rate in this case. Usually, this is also something which is of high interest, not necessarily for the FX trading world, but something which is probably interesting for equity traders. Some of you, when reading my Vita here, you will see that I am a former professional trader in regards to a position as a trader at a big broker, in fact. So a big broker in equity. So I'm not referring here to CFDs and OTC products, but I was responsible for quoting shares at the stock exchange here in Germany. In this case, in Berlin, it's only a small one, but still. The thing is that when quoting here, so we usually had two ways to talk about a quote, in fact. So I'm not really sure whether in the English world there is a reference to this, but we had two things. So we talked about a so-called taxe, and we talked about a quote. So when it came to taxe, that is something which is also a quote, but there is no number of shares you have to stand for when quoting for. So or where you have to provide or to give the one who's hitting you on the bid, respectively on the ask, something I will refer to a little later on. Which means that you don't have to give away, or it depends on how many shares you are giving out, or you have to, for example, sell to the one who's coming to you, saying, okay, now I want to buy this and that share for €10. So if you're giving a quote which says 9.95 to €10 here, and this is usually a taxe, so this is only an exchange rate, respectively. It's not really, well, something like an exchange. Yeah, it's a quote, but without having a size connected to it. That means if someone comes and then you say, okay, I have, for example, I'm willing to sell you for €10 this and that share. I give away, let's say, 100 pieces of the share. So you get 100 in terms of the quantity, and that's it. But if you say, I am 9.95 to €10 for 1,000 on each side, you're not referring to quote to a tax anymore, but then to a real quote. This is like you have to sell the one once someone is coming to you and says, I want to buy this share, 1,000 pieces. You have to really give him those 1,000, and this is something which is not really important in case of FX due to the depth and the width of the market in general, but still probably something which is of interest for some people where there's a difference. So especially those who are wondering if there is some speciality to it when it comes to exchange rate, respectively quote. So usually what we do is we refer to that as an equivalent. Still, there can be a difference. So one says I have no size connected to that, while on the other hand, I have a size connected to that. In case of the FX market, it's difficult because you usually have, as I already said, you have lots of quantity, respectively size, available due to the fact that the FX markets are the most traded and most liquid markets in the world. But when it comes to shares, for example, stocks, then there could be, for example, a difference. This is nothing which is of interest for you as a retail trader, but something which is probably interesting for professional traders / market maker making markets in certain and certain currency pairs, respectively, certain shares, and all this. So now let's have a look here at something also very interesting, the so-called bid and ask. I already referred to that. It's also very, very easy to understand. When looking here at the exchange rate, you can see the bid, in fact, is the price you can sell the currency to the broker, respectively. Here, the ask is the price you can buy the currency for. It's very interesting. Also, something which is high interest. So in German, we usually refer to that as so-called Geld und Brief. So it's Geld in this case. It's how can I say that? It's like cash. Yeah, probably we can say that. It's not really Geld. The equivalent in English in English is in fact bit. But in Germany we usually call it Geld. Respectively, the ask is the so-called a Brief, or it's the a brief. It's not the letter, but it's the paper. It's the paper you have for. And my former senior trader introduced this concept in a very easy way for that, a very easy but still understanding way. She said, when we refer to the so-called bit, or respectively Geld, we refer to that because we have the cash and therefore we are willing to buy. So when looking here at this quote and you look here at the sell button for a market maker, this is the price he is buying from you. And that's why we refer in German to this as Geld, or as being cash. While here you have the ask price and you buy for that, but this is the price the market maker, the broker, whoever, the liquidity provider is willing to sell something to you. So therefore, he has here the share which he is willing to give. So I'm Geld for what I want to buy from you. This is where you sell, respectively, the other way around. So for a professional trader who comes, who has this background, sometimes this is a little confusing. So when I, for example, look at this here, I know automatically that this is the price I'm selling for, respectively, this is the price I'm buying for. But still, it's probably kind of interesting that usually when looking at it from a liquidity provider, market maker perspective, broker's perspective, whatever, someone who's providing a market for you, that this is the price he's buying from you, why he refers to this as bid. So I bid a certain price here for which I buy from you. Probably you can understand this. Respectively, here, this is the ask. So you're asking, you as a client, you're asking for a certain price, for which I'm willing to sell to you then. So to introduce this then here, it's the bid is the price at which the market will buy a specific currency pair from you. Thus, at the bid price, a trader can sell the base currency to their broker. So base currency, this is the first, in this case, the euro. So I refer to it as the first currency, and then we introduced also the base currency in this case. And the ask price is the price at which the market will buy a specific currency from you. Will sell a specific to you. I'm sorry, this is not correct. So this is not right. So the ask is the price at which the market will sell a specific currency to you. So please ignore what's written here. Thus, at the this is funny. So it seems as if it was only copy pasted. This is not good. Thus, at the ask price, then the trader can sell the base currency to the broker. One second. Let me just overwrite this. This is not good. One second. Let me just switch over here. So this is not really cool. One sec. So the ask price is the price I will sell. Okay, sell a specific currency to you. Thus, at the ask price, a trader can buy the base currency from their broker. Okay, there we go. Now it makes sense. Okay, let's go back now to this one here. So, one sec. There we go. So now it makes perfect sense. And now I think there should be no irritation about what I just presented. So the bid is the price at which the market will buy a specific currency pair from you. The ask is the price at which the market will sell a specific currency pair to you. So where you can buy then, in fact. So that's it on bid and ask here. So now switch to the next slide. Now we have the spread. Therefore, we need to know what bid and ask is. And the spread is, in fact, only the difference between the bid and the ask here. So, in fact, if Euro USD in this case trades at, as here the example shows, 110.72.2 here and 110.72.7, the difference between those two is 0.5 pips, in fact. So displayed here. Okay, and this is in fact what the spread is. Nothing more, nothing less. So the difference is between the bid and the ask price. What you can also call the spread, something, it's very difficult to understand this, but let's come back to the introduction when I talked about Admiral Prime and their offering. So the main difference between Admiral Prime and Admiral, let's call it standard, is that when looking at the standard, you have all costs already included in the spread. So there's no commission on top you have to pay. While when looking at the offering from Admiral Prime, you have a commission you have to pay on top. Therefore, the spread is narrower than in the standard version, in fact. So why is this of interest? Because there's many brokers now out there who are offering, in fact, sometimes very, very, at first glance, good trading conditions. Because they say, well, have a look here. We have a commission of only whatever per lot. Let's say €4 instead of 5 or 6, whatever. Now the thing is that some traders might say, oh, this is great. I will go to the broker with the €4 commission per lot I have to pay on top of the spread, while ignoring that their average spread is wider than from the broker who is, for example, saying you have to pay €6 per lot, which means at the end that the spread is also the cost of trading a certain market or a certain asset, a certain currency pair in this case. So, which means nothing more than if the average spread is high, the cost of trading is high, and here this could mean that after looking at all costs involved, spread plus commission, a broker offering you lower commissions can still be more expensive than one offering you at first glance unattractive commissions, but having a very, very tight and a very, very attractive spread in this case. So this could add up here, and at the end you could find out that someone having a high commission is still more is cheaper than one who is offering a lower commission, but in fact has a higher spread on average than, which probably is also a sign of the broker not really having good liquidity providers, respectively, probably not the best relationships in the FX business, which is also something which comes down to regulation, which comes down to size of the broker, so which comes down to the business the broker is providing. So usually the brokers who are big, who are providing big business, who have a high turnover, who are highly regulated, are those with the most attractive trading conditions, in fact, or they are more likely to offer you very, very attractive trading conditions, in fact. So this is also something where you can already get an idea of, by not only looking at the spread, knowing what the spread is, so that's the difference between the bid and ask price, but on top of that, you have also a very good idea of the quality of the broker you're working with, yeah, where competitiveness then in this case plays a major role, and is probably of is probably important when it comes for you to decide whether you want to go with a certain broker or not. So looking at the spread and the average width of the spread here gives a very good, at least for those who are more experienced in trading, let's say, and more professional traders, gives a very good idea, very good feeling of what you can expect, especially if these trading conditions then are given during high volatile trading events like non-farm payrolls, Fed rate decision, ECB, and all this. Which is, by the way, also something I've forgotten this now. When looking at those events, for example, you probably have seen that the spread widens. So we don't want to dig too deep into this matter right now, but a widening spread is a sign of liquidity in the markets thinning out, in fact. So if you look at the bid and the ask, so usually under normal market conditions, and once there's a high level of liquidity provided and market depth, what you usually have is you have a very narrow or a very tight spread, in fact. So now let's assume we have a Fed rate decision as we had last Monday, or you have as we had last week on Friday, for example, we had the non-farm payrolls. Market participants become not only excited, but somehow nervous, or they are not really sure about how to interpret a certain news event and in which direction it will be published, for example. So what they usually do is they reduce their risk. How they reduce their risk? Well, they take down the position size, respectively. Probably they take out the orders of the order book here, in fact. Once the bid is taken, or several bid are taken out, and offers also, so the ask side, the spread naturally widens. So you can explain understand this as a kind of a ladder here, where you have here the bid, and there you have the ask, and usually here there's the difference. So the ask is higher than the bid, and once there's uncertainty in the market, the spread widens, and it narrows again once this uncertainty is then diminishing, in fact. So the higher the spread, the higher the cost of trading, and to some extent also the higher the uncertainty among market participants, especially when looking at such currency pairs like Euro USD, US dollar JPY, GBP USD, for example. So major currency pairs, some very deep and very, very liquid currency pairs. So now this is, in fact, very, very great bridge, in fact, for the next question. And this is probably something which is bringing also advanced traders some kind of aha moment right now. So this is the advanced lesson. So we already had an advanced lesson here with the news event and the widening of the spread, but this is probably even more crucial now to understand when looking at cross rates, for example. So there's an exciting question arising, and several people ask this over time, again and again and again. Why is the spread of cross pairs usually wider than the spread of majors? So when looking at the cross pair, in this case Euro JPY, what we know is there's some, it's obvious, in fact, so it's simple math, that it's the product here of Euro USD and dollar JPY. So these two here, the US dollars, are taken out, in fact. So at the end, you have only Euro JPY then here. So the thing is now very simple, that the two spreads for Euro USD and dollar JPY, they just add up, and so the spread of Euro JPY must be naturally wider. So once you want to buy Euro JPY, sure, you have a chance to buy Euro JPY, but at the end of the day, it's like you're buying Euro USD and you're selling dollar JPY in this case. So you can see it here. It's very great. So it's not perfect because the moment was not. I clicked on now make a screenshot, but unfortunately I wasn't capable of really getting here 1.4 adding up from 0.5 and 0.8. But you can see it's very, very, very close. 1.4 and 0.5 and 0.8, in fact. To some extent, sometimes it's also depending on the liquidity that you have and the order book you find yourself in when making a market for markets, respectively, the liquidity provider finds itself in. But I think this perfectly explains and gives you a good understanding of why major currency pairs usually have a tighter spread, because at the end of the day, the product of major currency pairs comes down as a result to a so-called cross rate. And that's why cross rates, because they include two spreads in this case, have a naturally wider spread than in this case. So yeah, that's it on the advanced lesson on spreads. Let's have a look at the next slide then here. Let's have a look at the so-called pip. So usually when we look at Forex, we look at the pip, and there's also something very, very interesting. It's sometimes you probably might have seen this. It's already the last point here, but let's come to this. You probably have heard about the pip, which is, by the way, short here for percentage in point, so PIP. A pip is, some brokers, respectively their educational material, refers to that as the smallest unit of a change in a quote, in a Forex quote, which is not true. The smallest change is, in fact, a pipette. Okay, it's not a pip, but it's a pipette. So a pip is the fourth decimal place here, but a pipette is the fifth. So when we're looking at a spread of 0.5 in this case, you have a spread of 0.5 pips, or you have 5 pipettes. Okay, usually we say 0.5 pips, but just to make sure that you become aware of this mistake, which is usually made, and it's also, at least for me, after several years in this industry, it's something where I recognize, or where I can decide whether a broker and the provided educational content is good, or it's at least something to wonder about, or to question, probably. It's when they start already to have trouble to distinguish between pip and pipette, then usually that's a sign of probably not take everything as granted what's provided there, let's say. So there's also something else which is interesting in regards to pip. So first, let's start here. Pip is short for percentage in point, a unit of a change in an exchange rate or a currency pair. Okay, but, and this is also interesting, major currencies are traditionally priced to 4 decimal places. So it's here the 4th number, or in this case of the mini terminal snapshot here, in this case this number is the pip. So unfortunately here I haven't such a rectangle around it. But now this is also something which is of high interest. There's now again something special about the JPY, the Japanese yen. There are some exceptions, like the JPY, which is priced to 2, in fact. So here in this case, so you can see it's EURUSD, and there you have dollar JPY. They usually should be the rectangle, but it's not the 4th place, but it's the 2nd one here. So here you have the dot, which is 1.1072, and there it's the 4th decimal place, while here it's point and then it's the 2nd. So this is the only, it's not a big difference, but still it's one worth noting, I think. And yeah, finally, again, a pip is not the smallest unit of a change in a quote. This is something we refer to usually as pipette. So then let's have a look here at another very, very important topic, probably especially after the ESMA decision, which went into effect here in August 2018. There was a big topic, and well, that's one of the reasons why we here work with the leverage now, which is for retail traders at 30-1 when it comes to FX trading, and when it especially comes to trading major currency pairs. So when looking at minor currency pairs, like let's say GBP Swiss franc, for example, so classic cross pair, there you have a leverage restriction to 20-1, in fact. But let's refer here to the classic retail example of major currency pairs. Margin is usually something we refer to as the deposit required to open or maintain a position in Forex trading. So margin can be either free or it can be used. So which means if you look at your MetaTrader or in your trading platform, you can see that there's use margin, which is the amount that is used to maintain an open position. So for example, let's assume here we have a 10,000 euro account and our leverage is 30-1, which means that you have to add this up then to 100. So you have a 3.33% margin requirement. That means that to maintain such a position here, you have to put in 10,000 divided by 30 in this case, so 333 euro to hold a position worth of one lot, in fact. So 100,000, I'm sorry, no, is it right? Did I say it right? One sec. So 333, yeah, exactly, I'm sorry. So that means that a mini lot. I'm sorry, I just lost one zero. It's a one mini lot. So worth 10,000 units of Euro USD. You have to put up 333 euros to hold such a position here. And this is what we refer to as used margin. While when looking at free margin, in this case, it's the amount which is available to open new positions. So once you have the position here, and in this case, you have used margin of, say, something like 500 euros or something, then you only have 9,500 euros available free margin, which you can use to open new positions with. And in fact, you can also understand margin as, in this case, the number, which gives you an explanation of how big the position could get before running into trouble here, respectively. It's theoretical possible with a 10,000 euro account and a leverage of 30 to 1 to buy or sell a position worth up to a notional 333,000 euros, in fact. Yeah, that's it on margin. So nothing more to add here, in fact. And at the end, now we want to dig deeper into leverage, and I already ask you right here a question. So that will come a little later, but since we are running out of time a little, I ask you the question right now without opening the slide here. So are there any terms you'd like to be defined, you're wondering about, which I could go through here without having them prepared within this presentation? Please let me know. Just shoot them over in the chat box, or in addition, if you're watching this now on YouTube, the recording, feel free to ask your question in the chat box below, okay, so that I can answer the questions afterwards. Yeah, while you probably type down your questions in the chat box, let's have a look here at the leverage. And how this is defined, in fact. So in short, leverage is the ability to gear your account into a position greater than your total account margin. For example, if a trader has 1,000 euro of margin in his account and he opens a position of 100,000 euro USD, his leverage is 100 to 1. This is obviously not a retail trader anymore, because after ESMA, this is not possible, because the max leverage a retail trader can get is 30 to 1. In fact, just to explain to you how this can be understood here, leveraging your account. So use leverage then is defined by the total value of open positions divided by the total margin balance in the account. So this is also something, usually it's not use leverage, but also you can refer to as so-called effective leverage, which has an impact on your overall chances to be profitable in your trading. So if your account size, for example, is 10,000 euros and you have one position of, let's say, 100,000 euros, only 100,000 euros, Euro USD here, your used leverage is 100,000. This is the position size divided by your account size, and then your leverage, your effective leverage or your used leverage is 10 to 1, in fact. So how can this affect your profitability in trading? It's not necessarily said that you become profitable by reducing the leverage, but there's a clear tendency. So what you can see here is a chart which I provided. Let me just think. Is it in my first book on Forex trading? It was a specific book, very, very specific, or is it in a second? It's called Trader. It's only German, by the way. So don't get me wrong here. It's not to promote the book, but for all the people listening to this right now, I expect you to be not really fluent in German. If you are, feel free to check Amazon. But for the English speaking community, this is probably not such a book of high value due to the fact that it's in German. I think it's from the second book. I have this chart from. So it shows the effective leverage here at the x-axis, and here the profitability or the likelihood of retail traders being profitable. This covers a time span of accounts which were analyzed over a 1-year period, in fact. So to just give you a number, when looking at Euro USD trades, for example, we looked at over 9 million trades here, and it was only Euro USD. And what was done then was we used the data and we tried to find out how likely is it for a trader to be profitable in dependence on a certain leverage he used within his trading. And the thing is that the higher the effective leverage was, so the higher the position size grew, in fact, the more unlikely it became that the trader was profitable. So in fact, once the effective leverage or the used leverage in the account exceeded 25 to 1, so you have a 10,000 euro account and you're leveraging the account 25 times, which means you're trading positions, in this case, up to 250,000 and higher, then the likelihood of the respective trader of being profitable was only 18%. While when reducing the effective leverage here to below 5 to 1, the likelihood of this trader grew to over 40%, or to around 40%, in fact. So to give you a number on this, so if you have a 10,000 euro account and you're trading then, let's say, 30,000 units Euro USD, you're using 30,000 divided by 10,000, and your effective leverage goes down to 3 to 1 in this case, making it likelier that you're profitable within your trading. There's certain reasons for that, especially psychological ones. So we once had the connection of trading psychology and risk and money management, respectively position size, and that the higher position size grows, the more emotional you become, the more likely it is that you underlie a concept which is called loss aversion. But in fact, so this is the graphic behind this, perfectly illustrating why leverage and profitability are to some extent connected to each other. Still, after ESMA, we can also see that this is not the only reason, because trading without an edge, let's say, does mean that it only takes longer for you to bust the account, but the fact that you're losing leverage will rather sooner or later result in a bust of the account. So it's not only coming down to reduce the leverage, but also make sure that you're trading with an edge, that you're trading with a profitable trading strategy. Once you don't have this, chances of being profitable or successful within your trading indeed become unlikely, let's say. So yeah, and so in fact, we're coming to the end here. So the question is, but so far I can't see any questions. Let me see. Are there? No, numbers of attendees is there. So it's not that I'm alone here, but so far it seems as if no questions around Forex terminology are given. So if they arise over the weekend, let's say, feel free again to post them below the video here on YouTube. I'd really like to answer them for you. I'd more than appreciate this. And yeah, so in fact, that's it then from my end. Don't forget to join us next time, sure, on Monday. I'm sorry, on Monday, not on Wednesday, on Monday, Paul will be here to learn and talk about his top trading ideas for 2020, including the mini recap of 2019. How has the market changed and what position does this put us in for 2020? His top trading ideas, markets and potential trades which could arise. And yeah, check your inbox for the link. 2 p.m. London time on the 16th of December. It's Monday. So if you're watching this on YouTube, feel free to reach out to admiralmarkets.com. Go to the tab Education, and there under webinars, you can register for free here for the Trading Spotlight webinar series. And once you did this, you get an invitation every time such a Trading Spotlight webinar takes place. So, oh, I'm sorry, that wasn't good. I'm sorry. That was the wrong one. I clicked the link. So there we go. admiralmarkets.com. Feel free to check out the website for further informations. And now we close the cycle here in regards to the regulation. So at the end, we have to have a look here at the risk disclaimer. Contact details first, sure, and then we have here the risk disclaimer. That's it from my end. So all the best. Have a nice weekend. Enjoy yourself. Talk to you again next week on the 20th of December. I definitely look forward to it. And all the best from my end. So see you. Talk to you soon. Bye-bye.